Today we will analyze why quality stocks are interesting, especially for individual investors, because they are boring. The flashy high yield from prominent stocks like Nvidia and Co. seem to take all the attention, while for many investors, a good investment comes not only with a good yield, but also with low volatility. Stocks like Henkel from Germany, Coca-Cola, Procter and Gamble, and Waste Management offer an attractive longevity for which investors pay a premium. All stocks offer some of the most boring products like soap, soft drinks, or just picking up your trash, but they are cash machines. Imagine you're an average person living an average life. You go to work, drive home, cook and drink something, do laundry and go to sleep every day. What sounds pretty boring is roughly the life of everyone. But what makes it so special that investors think they can create a great business story from this? Well, it's the repetitive character that comes with this. Every week you do your laundry, every day you cook and eat, every day you get your shower and brush your teeth. Since Wall Street strives to always be optimistic in the long run, we find this to be pretty amazing. Every day an average person uses the same product, like a fictive subscription. The best part is that the companies must keep the product's quality the same. Otherwise, the most loyal customers will leave. But why is this so special? In finance, this is called recurring revenue or subscription revenue. Instead of selling a product once to a customer, companies nowadays try to establish a recurring revenue by getting customers to buy the product periodically, which results in steady revenue streams. Examples are Henkel, Coca-Cola, and Colgate-Palmolive, which all share similar characteristics over growth stocks. First is the price per earnings ratio. It's calculated by dividing the share price by the earnings per share, resulting in years, indicating how long an investor has to wait to recoup the share price with its current earnings. Colgate-Palmolive and Coca-Cola have PE ratios of 25 and 26, currently underscoring the S&P 500 with an average of 29, and Henkel with 18 is at the same level as the Europe Stoxx 600. So quality stocks tend to be lower or at average, while growth stocks even have higher PE ratios, like Netflix 52, Broadcom's 180 or ARM's 215. Indicating many future earnings to be already priced in. Just to be clear, ARM's current multiple is 215, meaning the investor has to wait 215 years to recoup the share price. Of course, in reality, growth stocks grow into the valuation, meaning their revenue and profit grows so fast it justifies its temporarily high PE ratios, because if the earnings rise faster than its stock price, the PE ratio lowers. A second characteristic of quality stocks is that they pay a sustainable dividend. In fact, most of them are dividend aristocrats, meaning they increased their dividend in each of the past 25 consecutive years. And third, quality stocks provide safety by having more financial stability. This is reflected by a lower volatility than growth stocks. It can be argued that volatility is not the best metric for low risk, since it also includes upside volatility. Instead, looking at the maximum drawdown from the last peak results in typically lower pushbacks in bearish markets. Henkel is a German consumer goods and chemical company, which is known for brands like Dial, Persil, Purex, Brit, and Schwarzkopf. Henkel matches our three criteria of average PE ratio, financial stability through returning revenue, and a dividend yield of over 2%. The same accounts for Colgate-Palmolive, selling products like soap, shampoo, shower gel, and toothpaste. Colgate-Palmolive's most popular brands are Colgate toothpaste, Palmolive shampoo, completed with Elmex toothpaste, or dog food from Hill's Science Diet. All these brands have some characteristics in common. They are boring and customers are continuously buying them. This combination is great for quality stocks since they are reliable and strong for investors. How often do people change their morning routine and switch their toothpaste, shower gel, or laundry detergent? Or give their beloved dogs different food than usual? The stability and sheer boredom brought by these products are the key reason investors are interested in these stocks. Let's have a close look at Colgate-Palmolive's financials. Their current PE ratio is at 26, with a margin of 24.15%, while its closest competitor, Procter and Gamble, is valued at 27.7 PE ratio with a margin of 28.57%. While PG is 5 times as big as Colgate-Palmolive, its profitability is slightly higher with a much larger management overhead. Even the dividend yield of both is comparatively the same, with 2.19% for Colgate-Palmolive and 2.32% for Procter and Gamble. The key question remains, why are so many investors attracted by these boring companies? The answer is relatively simple: longevity. At Wall Street, we have three main categories for stocks: growth, value, and quality. Growth stocks typically are technology stocks that tend to grow fast but have a high volatility. Prominent examples are Nvidia, ARM, Netflix, Tesla, Palantir, and a German high-tech semiconductor stock like Microsys. But this category is not limited to technology, since in recent years we have also seen stocks like Celsius, Monster, or Hims & Hers Health, which tend to yield and work like growth stocks, but also come with the same amount of uncertainty. Growth stocks are mostly traded by either risk-friendlier or younger investors because time is on their side. The next category is value stocks, which Warren Buffett is always searching for. They tend to be hard to find and are typically fallen angels. A recent example is Boeing. Once the shooting star in the aerospace and defense sector, is currently tumbling with quality issues. So value stocks are attractive since their value is so low that it is rewarded disproportionately when investing. By buying securities that appear underpriced by some form of fundamental analysis, investors might earn an exceed amount of return. They would not without researching and taking the risk as with value stocks. And lastly, quality stocks are more or less in between. They are by no means undervalued. In contrast, they might be priced relatively to the current market average PE ratios, tend to work in established markets with established products with relatively low volatility and an average to lower returns. Stability is the key benefit and helps investors participate even in turbulent times. And as this Barron's article finds, the consumer staple sector currently is more or less lagging behind the rest since technology is overinvested. Many forget who is producing their beloved shampoo or drinks. This might be the opportunity for investors seeking low risk and secure growing dividends as another satellite in your portfolio. As Barron's article points out, consumer staples account for the largest portion of the S&P 500 Dividend Aristocrat Index, with 24%. This index is currently trading at a 10% discount compared to the S&P 500. Now you know why currently it is a great time to buy boring stocks where everyone else is seeking exciting AI and technology stocks. And the next time you're out in the wild and you see a shampoo, dog food or Coke, you know what tremendous business model each of these stocks offer and why boring is exciting. Thanks for watching and see you in the next one.